Thank you all for joining me this morning, and I hope the weather is as beautiful in your parts of the country as it is in glorious Wellington this morning. My name is David Beattie, and I have been a part of the Booster team now for 22 odd years, having spent 15 years with Westpac prior to that, mainly as Chief Investment Officer. So my background's in investment management, but more latterly I've spent some time just focusing a bit more on retirement issues, and for a lot of us that's becoming a bigger issue every day. So I hope you get some good information out of what I'm going to talk through. Just a quick disclaimer to highlight and remind people that all that I'm talking about today is really of a general nature, and I can't really give specific personal advice to everybody. And there are circumstances that you have that need to be taken account of. In that regard, it's always useful to know that as a KiwiSaver member, you have access to an advisor somewhere in the country who can help you talk a bit more about your KiwiSaver planning. And okay. The other thing I'd just like to mention, having now removed myself from the video so that you can focus on the screen, is that this is the third webinar in this retirement series that I've done. And if you haven't already had a chance to have a look at those, I would strongly encourage you to do so. There's a lot of relevant content in those first two webinars that will help to bring this one particularly more into context. So if you haven't seen those already and you want the links to the first two webinars, send us an email and someone from our team will send you the link to those so that you can catch up. So for today, I'm going to take you through 5 sort of topics relating to focusing on withdrawal and income strategies from your KiwiSaver, but also more broadly in terms of generating retirement income. I'll start off by just dispelling a few myths that people may have in their minds and some mistakes. I'll talk a little bit about working past 65 as an option for some. Then we'll get into the nitty-gritty of spending your hard-earned KiwiSaver money once you reach the point in your life where you're able to access that. I'll have a little bit of a look at how other income options are available, and there are 3 main ones that we'll talk about there. I'll finish up with some context around some of the main uncertainties that we all face as we hit those magical golden years. And then I'll leave you some action points to follow up with afterwards to make this a bit more real. And then right at the end, we'll have some time for questions, and we'll keep an eye on that as we go through. So let's just start off with some myths and mistakes that I see people often making when it comes to thinking about retirement and retirement income generation. And the first one is cashing up. A lot of people, as they get close to that magical age of 65 where they can access their KiwiSaver money, think that the right strategy is to just cash everything up. But please don't think about that as the optimal strategy. And certainly don't close your KiwiSaver account, take all the money out, and then rush out to find alternative ways of generating income. So yes, you do, once you reach age 65, have full access to your money, but KiwiSaver itself provides a great foundation for providing a retirement income with a well thought out plan. Second common myth or mistake I see out there is that too many people start lowering their investment portfolio risk too much as they approach 65 as well. And in the first 2 webinars, I did talk a little bit more about taking a more seamless transition to retirement, where you aim to have at least around about a balanced portfolio at age 65, rather than it being all invested in cash. Now, there are some exceptions to that, and we talked about that in the previous webinar as well, in terms of paying down debt as a priority. But if you don't have that, Normally, you're sort of wanting to be aiming for that balanced portfolio. The third myth that I often find is people say, "Oh, I'm not going to spend my capital when I reach retirement. I'm just going to use whatever I've accumulated to generate income." But if you carefully spend some or even all of your accumulated KiwiSaver money, this can provide a much better retirement lifestyle. And I see that too many people deprive themselves of the retirement they deserve by not spending enough of their capital. You can do this with confidence, and I'm going to show you how to do that in the next few minutes. So let's just have a look at the second area of working past 65. And in the first webinar, I did introduce you to Booster's My Money Map tool, which is available to all of our KiwiSaver members on your individual website portfolio after you log in. So if you haven't, again, had the opportunity to have a look inside your own personal portal and use My Money Map, I can't stress enough how useful this is as a tool to help guide your retirement planning and thinking, and particularly when it comes to income generation, it's a very valuable tool. I also, in that webinar, demonstrated how powerful it is to just start thinking about working past age 65. And in that webinar, I used this slide where someone has accumulated a relatively small amount of money, just $60,000 from age 50. And is expecting to retire at age 65, in which case their money is going to last until age 74. But just by increasing the age at which they retire, if you like, and keep working for another couple of years, you can see very quickly that the amount of money accumulated is just about doubled in this example, and it pushes out their savings another 10 years. So just simply that adjustment to the age of stopping work can make a significant difference to how your income looks in retirement. Now let's just have a look at spending your KiwiSaver. And before I take you through a bit of a worked example, I just wanted to clarify that you can set up any type of automatic regular withdrawal payment from your KiwiSaver account once you reach age 65. For example, you can set up a fortnightly automatic payment to match the frequency of your New Zealand superannuation payments. I'll just go back. Some of these things are going forward automatically. So yeah, it's important to note that we do have a significant degree of flexibility once you reach age 65 and you have full access to money, that you can set up whatever you like to suit your own particular income requirements. So as you've already seen, I just wanted to have a look at this worked example. And typically someone's saving for retirement, their balance goes up progressively as they reach age 65, and then they hit the retirement age, and then you enter the spending phase or decumulation phase. So I'm going to have a look at what happens to someone who might have accumulated $200,000 at age 65. And if you're following the normal pattern of I'm just going to not spend my capital, you will probably end up, just wondering how I pause this because it's scrolling through a bit. There we go. Oh, well, I think that's hopefully set on the page now. But if you just keep all of your capital intact, the rule of thumb that's quite useful to have a look at is a 3% rate of return is what you can typically generate after tax today by putting your money into a low risk investment option. And that keeps your capital intact. So that would generate for $200,000 around about $6,000 per annum, 3% after tax. If you then used a 5% approach, which is a reasonable estimate of the average long-term after-tax return from a balanced investment portfolio, you can generate something approximating around about $10,000 per annum with your $200,000. So it's an additional $4,000. So we'll just hold on to that thought as we head into the next phase. So that's the first angle to take to look at what a lump of money can generate from an income perspective. The second angle, and probably the more important one, is what does your retirement spending budget actually look like? And it's usually a good idea to split your budget quite simply between what I call routine or unavoidable expenses and discretionary or special expenses. So just budget on those two main categories. This will make a lot more sense as we just work through some of these examples. I've picked a slide here again from the My Money Map, which is a great tool. It allows you to play around with your retirement spending budget, not only in terms of the quantum, but also you can tailor it to specific parts of your retirement years. Typically and often try and anticipate spending more in the earlier years when you've got good health and the ability to get out and about and do things, and then tapering it off as you get through. So that My Money Map tool is, again, very useful, and I'd recommend you go back and have a look at that. But let's just have a look at our retirement spending budget. So what I've done here is I've put together a bit of a draft starting budget of $35,000 for routine expenses that are known, unavoidable, and then another $15,000 of discretionary expenses on top of that. And that gives us a total of $50,000 per annum. And you'll note that I have selected that $50,000 budget as sort of halfway between what is often referred to as a no-frills lifestyle and a choices lifestyle. You can see there $31,000 per annum for a no-frills lifestyle and $62,000 for a choices. And these numbers come from the Massey University survey of retirement expenditure. So I've picked a number sort of roughly halfway between those at $50,000. So let's say we've got our budget together to do that. Let's bring those two things together. We've got our retirement income, and I'm using a 17.5% tax rate here. So from the previous slide, I'll bring those through as well. Let's start with the most significant amount of passive income you are going to receive for most of you in retirement. That is the New Zealand superannuation payment. And that 37,750 is the current annual amount payable to a retired couple who are both eligible for the New Zealand pension, and they're on a 17.5% tax rate. So it's a reasonable amount of what I call ultimate passive income that you're going to receive from the government. It's paid for life, inflation adjusted. Let's now add in the passive KiwiSaver income from the previous slide of $6,000. And that passive, I mean, if that's the sort of money you can receive from a lump of money with $200,000. And then on top of that, we can add the additional $4,000 that I talked about, bringing it up to 10 in total, for a total income of $47,750. Now, obviously, that's a fraction short of the $50,000 that we budgeted for expenses. So you can use the My Money Map tool again to do some iteration. And quite simply, what might happen is you go back and slice $2,250 off your discretionary expenses, bring the total expenses down to match the income. And in a nutshell, there's your retirement income budget and plan sorted. Now, obviously, that's very simplistic, but it gives you a bit of a working example that you can take back and use in your own personal circumstances. Now, the other thing just to note is that 37,750 I talked about is the New Zealand government pension. It covers, more than covers, in this particular worked example, the routine, known, unavoidable expenses that you think you might face in the budget. And that's important because that gives you a great deal of confidence to know that whatever happens, the New Zealand government is going to look after your routine expenses. And that's, in this sense, a real comfort. Let's just have a quick look at some of the other income options. And there are a few ways that you can augment your income outside KiwiSaver, like Airbnb-ing the spare bedroom in your house, for example. But I just wanted to talk about the three main options that are available. We'll start off with one of the more obvious ones, and investment properties have long been a favourite with Kiwis, but the recent significant downturn in property values, combined with some government tinkering with tax rates, etc., has been a useful reminder of some of the risks of owning investment properties. However, if you are confident with the more hands-on nature of this type of investment, and understand all of the risks involved, then rental properties can be a useful income generator. But I'm not sure that I would put all of my investment in there, though. The second other very significant major way of generating income is to take a lump sum and buy an annuity. And they are a great way of providing certainty of income for life, typically. So it removes some of the most significant uncertainty. But there aren't too many choices available in the annuity market in New Zealand at the moment. And as with all investments, there is a price you pay for gaining certainty, and it's typically in the form of a lower average potential return that you can get by buying that annuity. And as a bit of a guide, today you can purchase an annuity which will give you around about a 4% return after tax. Now, this may be a useful part of your solution, but bear in mind that you are also spending your capital when you buy an annuity. And I think usefully over the next few years, I would expect to see KiwiSaver providers offering a lot more attractive annuity options for retirees. The third area of income generation is in using the equity you built up in your home, or often they're called reverse mortgages. And there's an option for some people with a number of advantages. They're great. But there are probably three big negative factors, main ones, that you need to make sure you understand and consider. Firstly, your effective mortgage rate is at the floating interest rate. You can't take out a reverse home equity mortgage for a fixed rate, just given the nature of the type of arrangement you're entering into. So floating rates at the moment are obviously pretty high, around 8 to 9%. The second thing is your outstanding mortgage loan increases all of the time that you're in retirement, drawing down on the money, simply because you're doing that rather than paying off any principal. So your mortgage just gets bigger and bigger. And partly as a result of that, the third thing you need to be aware of is that you can normally only borrow up to the equivalent of around 25 to 30% of the value of your home. So just a useful guide for those other income options. I just want to finish up with dealing with uncertainties in retirement and all of the income issues that come with that. And one of the greatest uncertainties about generating retirement income is the issue of what if I outlive my money? And according to a lot of surveys, the fear of running out of money actually rates above the fear of death itself. So that just puts into context exactly how big of an issue this is with a lot of people, and quite understandably. Now, buying an annuity from day one does remove a lot of that risk, but typically, as I said, at a cost in terms of how much income can be generated. We believe there's potentially a much better solution which uses technology and smart investment strategies to optimize a managed retirement income strategy. And part of that strategy provides a great deal of confidence around how long your money is predicted to last. And you can use Monte Carlo simulation projections to give you that greater certainty about how long your money might actually last. But then more importantly, there are products around now which are called deferred income annuities or longevity insurance. Oh, let's go back, sorry. And for example, today, a person aged 65 could approximately use $50,000 of a lump sum to take out a deferred annuity starting from age 85 of around about $20,000 per annum for the rest of that person's life. So you can see with some of these tools, if you manage a portfolio all the way through from 65 to 85, on the basis of looking at what is the likelihood that you can manage that portfolio progressively down without running out of money. And then if you know you've got a deferred income annuity that kicks in, if you're still alive at age 85 to take care of the rest of your life, that does remove so much of that uncertainty risk about what if my money runs out before I die. So there are tools available, and that does allow you to carefully manage and spend your capital with a lot more increased confidence. Okay, so let me finish up now with a bit of an action plan. So the first thing to do is to go back and, if you haven't already, watch the first two webinars. So the road to retirement and 5 common mistakes to avoid in retirement. So if you haven't got the links, as I said, just email us and we can send those links to you. Second action plan, if you haven't already started thinking about it, but would be to put together a retirement spending budget and look at breaking that down into the two big categories of your routine, unavoidable expenses versus your special discretionary ones. And that'll help to give you a bit more of an idea of how much passive versus managed income that you might need, and look to have as much passive income, if you like, to take care of the routine expenses, and then your managed income can just form part of your discretionary spending, which can be lifted or reduced depending on how the markets go, how your lifestyle changes, how your choices evolve over time, and you can do that with confidence. Have a think about whether some of those other income options I mentioned are right for you. For some people, they do make sense, but for others, they just don't fit right. But it's important to go through and think about, are we going to be an investor in rental properties? Is a home equity mortgage right for us? Or should we just chuck everything into an annuity and then we're sorted? And for some people, those sort of options do work out. But I think what we're trying to demonstrate here is that you can come up with a very good optimized, managed option using your KiwiSaver money as the foundation to deliver a lot more certainty for you in retirement. Now, part of the getting a bit of a sense of what that might look like is just playing around with the My Money map tool that we've developed for you specifically to use. So go in and have a look at that. Once you've gone through all of those things, looked at the webinars, done your own budget, then you can start iterating and playing around with that tool, and it'll give you some good numbers that come out the back end. And then, finally, this is an area that does require a little bit of personalized attention. And if you're just not feeling happy with where things are going, I'd strongly encourage you to use a financial advisor to discuss and finalize that retirement income plan for you once you've had a chance just to play around by yourself to start with. And as I said, we've got financial advisors throughout the country we'd be happy to recommend to you. They will provide a free service if it's just focusing on your KiwiSaver money. But if you wanted to extend part beyond that, then by all means, you can have a chat to them and they'll give you some further advice. That's me for now. I'm going to click into the Q&A part, and we'll see what burning issues that I have spurred you into thinking about. So Jesse has asked, can we provide information for a single person? Yes, Jesse, we can do. Why don't you email us and I can convert all of the information that I provided for you today for a single person. I sort of wanted to focus on the married couple side of it, partly because the numbers for a lot of people are probably higher than what you're thinking about. But yeah, for a single person, not a problem at all. Just email us. There's a question here. This is a site called My Money Map. So it's My Money Map. They've got My Budget Pal as well. So they're two distinct different tools. One of them is a budgeting tool, and the other one is the retirement tool, the My Money Map. So I'm pretty confident you can access to both. Once you've logged into your account, you can access those. Oh, there's a few other questions just firing through. Paul, do you get penalised by the government if your property is paid up? Paid up. You might need to expand on that a little bit, Paul. I'm not quite sure I get the gist of that question. So I'll have a look at another one while you maybe rephrase that for me, if you wouldn't mind. So Moira's asked, if I have money invested in the bank, am I better to bring it into KiwiSaver? As a general comment, the answer to that is often yes. If you consolidate all of your lump sum investments into KiwiSaver, assuming that you're at that sort of retirement age, then yes, you can pull together a good coordinated answer to that. So generally speaking, I would say yes, but there are probably some personal situations where that might not be the case. NZ superannuation, is it means tested? The answer to that is no, which is a great feature of the New Zealand government. Do Dwayne's asked about life annuities, examples of downsides of these life annuities. Once you buy an annuity, you're typically losing a fair bit of flexibility. I mean, you're locking in an answer that is for life, but once you've done that, the flexibility to adapt if your lifestyle changes, your goals change, is a lot more limited than if you have your portfolio in a managed account where you've got a lot more flexibility to deal with those. So that's probably the biggest downside with annuity, just lack of flexibility. Paul, right, so do you get penalised by the government if your property is paid up if you are mortgage free? The short answer to that is no. You shouldn't be penalised by the government. Linda's asked if there are any specific annuities I would suggest. Look, there's probably only one major annuity provider in the market at the moment, and that's Lifetime. So I'm not necessarily making a recommendation for them, but I know Lifetime have done a lot of work in this space, and it's a tricky one to be able to provide some sort of competitive annuity. So for some people, it does work out quite nicely. So they would be the company I would probably start with. Okay, thanks, Paul. I hope that answered. It was just a simple answer, so that's great. Looks like we're all done. Thank you again for taking the time to join me this morning, and I hope that's given you some answers to questions and some food for thought about your own retirement income planning. And I look forward to joining you again for our next webinar in 3 months' time. Cheers.